Right, let's look at some common misconceptions that people have about the UK property market.
Yeah, I mean, first one is they often think that you need a lot of money to invest, you need to be super rich. You don't. You get super rich from investing. It's a simple fact. I mean, if you're looking at London, yes, you need a lot of money to invest, but this is where the northern market comes into effect, especially in today's day and age, in today's market, in the economy, whilst it's growing. So you actually only need around £40,000 to £50,000 to be able to enter a market at a good spot in Liverpool.
Yeah, well, most people wouldn't know that, would they? That's
exactly. So I think for me, that's the biggest misconception. When it comes to misconceptions amongst the property market.
I think my personal favourite and probably the most common is that London's the only safe bet. People do tend to think, and naturally so. I think it does make sense when you sort of take a step back. London is notorious for the property market, for its growth, the yield, the cash flow. It always has been for 50, 60 years now. So it's understandable why people do view it that way. But I think when you look at it, when you then look to the north and you look to the northwest specifically, and you're seeing growth forecasted at 20 to 28% within a 5-year period, rental yields, rental prices are increasing at levels which are now bordering on matching London, and definitely meeting, coming to almost a central point. But I think a lot of that's been driven from probably from COVID, to be honest with you. A lot of people know now that they don't need to be in London. So as much as it is a very saturated market, working from home, it's not so much with when it comes to actually people living in those. I think what you find with London is you get a hell of a lot of very, very large investors that are buying but not living in, which is great, but it's not for you as an investor who's trying to build a portfolio. It's not where you're going to see those kinds of returns and success. That is my number one, but again, understandable is the one.
Yeah, I think something ties into that nicely is a lot of investors have a fear of the market crashing, and and I get that quite a bit, and it's an interesting point because no one can sit here and guarantee that it won't crash. But just kind of going back to what I mentioned earlier, you look at the market over the past 20, 30, 40 years. There's been a number of crashes. I know there's a misconception about the interest rates being quite high at the moment, but in the 80s they were
19%,
and they just stopped people buying. You ask anybody who invested in the 80s, are they laughing about having a property now which is triple, quadruple in price? Of course they are. So the beauty of the UK market is the stability it provides, the track record it has, and the ability to bounce back from any crisis. So although we can't sit here and say there'll never be a market crash, it's a window of opportunity for a savvy investor to buy during a market crash and then benefit from the capital growth as that market grows.
Absolutely.
And I think it's a unique offering the market has here in the UK, which is why we get an influx of overseas buyers. It's the highest buying market amongst the overseas buyers internationally, and for good reason.
And absolutely the most proven. I mean, there's no
proven track record.
It's amazing to see.
100%. It's for me the top kind of factors I would say that pinpoint the UK as the best investment location is the legal transparency, which not a lot of countries offer. The solid framework, the legal framework, and the proven track record. I think those three, the combination of those three, and the way the economy is growing, sticks us out.
Absolutely. What's the current situation in the UK property market?
Good question. I think the most prominent for me is the increase in the rents. We find that over the past 18 months, where the buying generation has now switched to a rent generation, the rental market has really gone into a boom. For example, the rents have increased by 6% over the past year, particularly in cities like Liverpool in the northwest, where you can get yields of up to 9%. And many data analyst companies forecast Manchester and Liverpool property prices to increase by roughly 20% by 2028.
Why is that? What's driving that level of growth?
Look, it's a number of things. I think everything from the level of regeneration that's happening in Liverpool, the diverse city and the vibrant culture, more so the student retention rate. Over the past 5 years, 5 to 10 years, I'd say, more and more mainstream businesses are coming into Liverpool and providing high salary jobs for graduates who are finishing uni. So naturally, more and more graduates are choosing Liverpool as a city they want to start their professional lives in. What are your thoughts?
Yeah, no, I think you're absolutely right. I think it is a huge driving factor naturally with the student retention rate. It's a huge it's a huge increase in the population each year on year. I think the key driving force behind Liverpool's development, and was probably behind Manchester's development as well, is the acquisition of the docks. So there's a company called the Peel Group. You'll probably be quite familiar.
Media City.
That's it, exactly that one. So they've now bought 2.3 kilometres of the dock space for mixed-use purposes, which is not only going to transform the docks themselves, which are very historical in their own right, but the city moving backwards as well. It will have a huge impact on the level of growth that we do see over these next few years. Yeah,
I mean, look, there's no doubt about it. I think Liverpool is defying the slowdown of the market, with property prices have increased by 7% and rents are up as much as 10%.
Yeah, which you wouldn't expect.
It's rare. Yeah. So what do you think first-time investors, what are the kind of questions the first-time investor should be asking themselves?
I think to be honest with you, Bill, first and foremost would be the rental yield. What is the rental yield? What are you going to achieve from this investment? If it's sub 6%, I would say it's usually not going to stack up once you further. This is it, exactly that. You're investing in the north for the yield. You're investing for the growth and for the yields as well. So I think anything below 5% is an absolute no-go. Naturally in London, that's what you'll see. You need the price point to be able to match that. Second question that I would always be asking is, what's the outlook on capital growth? What are these next 3 to 5 years going to look like for me? Most analytical companies are now forecasting that the northwest of the UK will achieve
huge,
20. Well, it's absolutely that. But we'll achieve at least 20% by 2028, which is a huge level of growth. Number 3 is your tenants. What's the demographic? What is the area that you are buying within? The tenants, they're the ones that are paying the rent, the ones that are going to be giving you your income. So at the end of the day, they need to be reliable and they need to be able to be matching what you're offering as well.
100%. I think that's why Liverpool is such a strong rental market at the moment, because of the diversity amongst the tenants, everything from young professionals to students, mature students. And it's a great city for short-term lets, with the 2 very historic football clubs, the music festivals that go on in Liverpool. It's what's driving the Liverpool market.
Absolutely, it's a young city in more than one aspect, isn't it? What would you suggest I do with my investment? Is it more effective to get it managed? Is it better if I manage it myself? What's the best route?
It's a good question. It depends on how hands-on or hands-off you want to be as an investor. We particularly find that a lot of our clients are actually based internationally, all around the globe, and quite often aren't on the ground to look after the property themselves. And having worked in the industry for 10 years, I know the consequences, the impact of working with a bad property management company. We're lucky enough to partner up with Curlett Jones, who are actually one of the most reputable companies I'm sure you've heard of in the industry. And they're very client-centric and also tenant-centric. So effectively speaking, you can have a very well-managed property where they source the right tenant for you, advertise the property, collect the rent on time, which is really important to avoid void periods, be the first point of contact. So you can be based in the country or anywhere in the world and have a very well looked after property, which again avoids void periods.
Yeah. Well, it does make sense then, really, doesn't it? Because to have people that are on the ground, that know the market, that know the surrounding areas and what tenants do, what makes a tenant tick, what doesn't. I imagine that is going to more massively reduce your void periods, which 100%. Really is the make or break of your investment. Because a 7% yield can very quickly become a 3-4% yield.
We see it happen. We see it happen all the time.
Yeah, absolutely.
And that's why it's important to go with the right management company to make sure you are getting the numbers that we predict at the point of sale. It's important for us as a company to work with the right property management company to provide that level of service to our clients.
100%. Yeah, couldn't agree more.